look back over the past year, it has been clear to see that copper prices have been almost solely driven by two factors. Firstly, by expectations surrounding the outcome of US tariffs by Section 232, lifting LME copper 3-month prices well above their fundamentals on artificial tightness over the first half of the year, before prices then became tightly bound to US dollar volatility, with the September FOMC 25 basis point rate cuts marking the first time the Federal Reserve moved to cut rates under Donald Trump's second term as president. Looking to year end, with the COMEX LME arbitrage having fallen back to levels at the end of 2024, we expect copper to gradually take back its characteristics of being Dr. Copper and once again be relied on as a bellwether for the global economy, given copper's universal use in various industries. With this in mind, we expect a sharp refocusing on copper's underlying fundamentals to predict future prices, with copper's latest move above $10,200 per tonne a direct result of increasing supply concerns, most noticeably with developments in Indonesia. So looking to 2026, we forecast a neutral to bullish macroeconomic themes, with 100 basis points of US rate cuts expected to aid cyclical demand recovery, alongside a push from China to boost economic growth, with 2026 marking the start of the 15th five-year plan. Here we forecast that infrastructure spending on key areas such as electric vehicles, the national grid, renewable energy, and AI will underpin steady demand, offsetting in part ongoing declines from the property market, while risks to external demand remain given the new tariff landscape. Downside risks may present themselves in the form of a further escalation in geopolitical tensions, with no end in sight for the Russia-Ukraine war, conflicts in the Middle East, while uncertainties remain over the global trade landscape, with BRIC nations forming closer ties against the West, and China and the US yet to have agreed a trade deal. Having said this, investors will likely maintain their long-term bull outlook for copper, with structural deficits forming towards the end of the decade, providing price volatility. We expect that mine production has posted its first annual decline since 2017, with output having fallen to its lowest level since 2023, driven by a host of supply disruptions within key producing countries, such as the DRC, Indonesia, and Chile. Indeed, in the DRC, the Kamoa-Kakula complex cut its 2025 production guidance by a significant 28% this year, while on a year-to-date basis, output from the largest producing country, Chile, remains below 5-year averages. Meanwhile, Freeport-McMoRan has suspended all operations this month at its Grasberg mine in Indonesia, the second largest mine in the world for copper, due to a mudslide. Here, pre-accident operational levels are not set to return until 2027. Looking to the years ahead, we forecast that mine production will steadily improve, with a compound average growth rate of 2.2% over the 2026 to 2029 period, given the number of announced projects and ramp-ups across Zambia, Mongolia, and Chile. However, risks are skewed to the upside, with the average disruption allowance exceeding expectations over 7 of the last 10 years. This is enhanced by the reality that more than 50% of copper production stems from just 3 countries, Chile, Peru, and the DRC, with South American producers long suffering from falling ore grades, droughts, alongside social and political unrest. Looking to refined production, we expect copper output will grow at just 1% this year, its lowest level since 2020, before recovering to average growth of 2% over the 2026 to 2027 period. Output has been limited this year on the tight concentrate market, with Q3 RCTCs falling into negative territory, marking the first time long-term pricing has fallen below zero. Global copper smelters will enter a state of loss when TCs fall below $20 per tonne, and therefore, as a consequence of building smelter capacity globally, several smelters outside of China have shuttered, including the Philippines and Namibia. However, despite these negative treatment charges, Chinese production continues to remain healthy, with growth forecast at 8.1% year-on-year, supported by state-backed funding and high prices of byproduct credits, for example, sulfuric acid and precious metals. Copper demand in 2025 is set to slow year-on-year to 2% from 2.6% previously, with robust demand in China and modest consumption in Asia ex-China offsetting declines in Europe, Japan, and the United States. Within China, consumption growth came from copper's use in renewable energy, AI, the state grid, and new electric vehicles, while demand from copper's largest end-use, construction, continued to come under pressure from deepening declines in property investment and a large inventory overhang. Looking ahead, we expect copper's demand to benefit not just from fast-growing digital and green demand sectors, but from recovery in the global industrial cycle. However, risk from trade tariffs will remain a headwind.